Hello and welcome to this session in which we will discuss the auditor's responsibilities for illegal acts. Illegal acts, also known as non-compliance with laws and regulations. In the prior sessions, we looked at the auditor responsibilities for material errors and fraud. I believe it's worth covering illegal acts separately. There are two types of illegal acts that we need to be familiar with. Illegal acts or non-compliance that have a direct effect on the financial statements. In other words, this illegal act affects either the dollar amount on the financial statements or somehow it affects the disclosures. And we have illegal acts that have an indirect effect on the financial statements. They don't affect the numbers directly or the disclosure, but they help us learn about the company a little bit more. We need to be familiar on how to deal with both acts. Direct effect on the financial statements, what are those type of illegal acts, and indirect effect on the financial statements. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. Illegal acts with direct effect on the financial statements are those that are related usually to taxes and pensions. Why? Because taxes and pensions are heavily regulated by laws and regulations, and they could impact the amount of taxes, tax expense, tax liability, or the disclosure, as well as pensions, how much liabilities to book, how much expenses to record for that particular year. For instance, breaching federal tax laws can alter the income tax expense as well the income taxes payable. It means it affects the income statement as well as the balance sheet. Auditors are responsible for gathering enough relevant information, considering significant amounts and disclosure that laws and regulations directly influence financial statements. Once we suspect a violation in any laws that directly affect the amount and the disclosure, we have to make a reasonable assurance to collect enough information to learn about the issue. As an example, how to respond to a potential violation? Well, to detect any substantial violation of federal or state tax laws, when auditing income tax expense, we might engage in a discussion with the client staff. We might review the Internal Revenue Service code. We might examine their tax return. Once again, we're not preparing their taxes. We're examining the return to determine if there's a violation on that return that's going to affect the balance sheet as well as the income statement, which is the financial statements. Those are examples of violation that have a direct effect on the financial statements. We could have violations that have an indirect effect on the financial statements. Many laws and regulations, they may not directly impact the financial statement, but compliance with them is essential for business operation and to avoid significant penalties by the state government, the federal government, the local government, or regulatory agencies, or other companies sometimes. For example, operating licenses, federal safety standard like OSHA, environmental regulations. Now, to detect compliance with laws and regulation that could materially affect the financial statement, what should we do? Well, the first thing is ask management and governance personnel about the entity adherence. Just ask them, are you aware of any violations that we need to be aware of? And if so, we need to determine if these violations affect your financial statements. 2, examine any communication with relevant licensing regulatory agencies, the government, local, state, and federal. During the audit, additional procedures might reveal suspected non-compliance. Follow up on that. If non-compliance is identified or suspected, we are obligated to conduct further audit procedures beyond the already we outlined or we planned for. However, we're not required to actively look, but if something came up, we need to follow up. What happened once non-compliance is identified or suspected? Now we know something happened. We suspect something. Well, the first thing is acquire clear understanding of the situation. What exactly happened? Engage in a discussion with management. Start to talk to management. And you want to do that a level at least above those who are implicated. The auditor must also assess the potential impact on the financial statements. That's our whole purpose, is does this non-compliance, a violation of laws and regulations, impact the financial statements? We need to assess this. To ensure the accuracy of the financial statements, we are required now at this point to gather adequate evidence concerning significant amount directly influenced by this violation. Additionally, the identification or suspicious of non-compliance, how is that going to affect us as auditors? Risk assessment for this company goes up. Presentation by management, their credibility of their presentation usually goes down. Now we are questioning their integrity. Is this behavior limited to violating laws and regulations? And seldom that's the case. Because if a company or if the management is unethical, I could assure you it's not limited to violating laws and regulation, federal, state, or local. You have to be on the lookout for additional violations that comes to financial statement. The trustworthiness of management on other assertions at this point might be questionable. What do we have to do? Do we have to report non-compliance? If it's a minor issue, well, we should at least inform the board of directors about instances of non-compliance. It's a good idea to let the governance body know that there are instances of non-compliance. The next thing we should do is we should assess whether we need to communicate this information to external parties. We don't run immediately and inform the Environmental Protection Agency or any other agency. I'm not sure if this one still exists in its current term, EPA. We have to assess whether that's required or not. Just don't go running and inform government agencies yet. Now, if the non-compliance has a material effect that's not appropriately represented in the financial statements, if it affects the financial statement and the company don't want to fix this, we might issue a qualified, depending on the violation, or we could also give an adverse opinion, which is, it's the worst. Qualified means, except for this, everything else looks good. If management obstruct the auditor from gathering adequate evidence, the auditor might issue either a qualified, depending on the situation, or might even disclaim, no opinion, I'm out. I cannot do anything at this point because I am not giving access to what I need to learn about this non-compliance. Because this non-compliance might be affecting the financial statements and disclosure in a material, significant way. Let's take a look at this multiple choice question from Farhat lectures. Which of the following should be performed first by an auditor who suspects that an act of non-compliance with laws and regulation might have occurred? So the question is asking about the first. What should you do first? Well, let's see. Express a qualified or adverse opinion on the financial statement. Well, I would say this is a serious issue. You don't just jump and give them an adverse opinion, which is the worst type of opinion, let qualified or even adverse. So that's definitely not the first thing we do. So A is out for sure. Obtain additional information to evaluate the possible effect on the financial statement. This looks very reasonable statement, but let's look at C. Consider the need to obtain legal advice. Well, you might have to obtain legal advice, but that's not the first thing you do. First, you want to see if there's any possible effect on the financial statements. Then we'll proceed from there. We might need legal advice, but that's not the first. So C is out. Let's see if D is a good option. Consider withdrawing from the engagement. Oh, not yet. Let's evaluate the possible effect on the financial statements first, before we withdraw, before we give a bad opinion, before we seek a legal advice, before we go running to regulatory agencies or government agencies. So B is the correct answer. What should you do now? Go to Farhat lectures, look at additional MCQs, true, false, multiple choice questions. That's going to help you understand the concepts better, help you do better on your CPA exam, or if you are an accounting student, perform better in your course. Good luck. Study hard, and of course, stay safe.